What happened around Venezuela is not a footnote, and it is not noise. It matters, politically, economically, and strategically. Any move that tightens pressure on a major oil-producing state carries real consequences, both for the country itself and for the broader system it operates within. To dismiss it as just another sanctions story would be a mistake. At the same time, focusing only on Venezuela or on Nicolás Maduro as an individual risks missing the larger picture. The significance of this moment does not lie solely in who governs Caracas, but in what the episode reveals about how power is exercised in today's global economy. Venezuela is not irrelevant, it is exposed. And exposed systems often show us how pressure truly works. Oil sits at the center of that pressure, not as a symbol, but as a mechanism. Energy moves through a dense web of shipping lanes, insurers, compliance frameworks, ports, and financial intermediaries. When scrutiny increases around any oil exporter, especially one already operating under sanctions, the effects do not remain local. They ripple outward, altering incentives, raising risk premiums, and reshaping behavior far beyond the producing country itself. This is why the recent escalation around Venezuelan oil flows deserves attention. It is not merely about enforcement against a single regime. It is about how quickly energy, finance, and geopolitics intersect once uncertainty enters the system. Venezuela is the immediate arena, but the dynamics set in motion extend well beyond its borders. To understand what comes next, it is not enough to ask what happens to Venezuela. The more important question is how this pressure interacts with global supply chains, discounted energy flows, and the strategic calculations of major consuming powers. When oil becomes harder to move, even marginally, the consequences are felt not only by producers, but by the economies that have quietly integrated that supply into their planning. And this is where financial markets begin to read the situation differently than political headlines do. Markets don't move on isolated political moments. They move when a seemingly local event touches the plumbing, the pipes that carry energy, credit, insurance, shipping access, and ultimately confidence. And when you watch the plumbing instead of the politics, what looks like a regional enforcement action starts to resemble something else. A stress test of the global system. Not because Venezuela is the center of the world, it isn't. Not because one leader matters that much, he doesn't, but because oil is never just oil, and enforcement is rarely just enforcement. Oil is a strategic commodity that travels through choke points, physical and financial. Tankers cross oceans, but they move inside a web of insurers, compliance desks, port permissions, ship registries, and risk premiums. If you disturb that web, if you inject just enough uncertainty, barrels can slow down without a single dramatic interception. The market does the work for you. People hesitate, firms step back, paperwork becomes a wall. That's the part most viewers never see, and it's the part that matters. Because if Washington signals tighter scrutiny around a sanctioned producer's exports, whether through enforcement messaging, compliance pressure, or visible maritime posture, the immediate question isn't what happens to Venezuela. The real question is, who was benefiting from that flow, and what happens when the discount supply becomes less reliable? And that question points you far beyond Caracas. For years, Venezuela's crude has been a kind of geopolitical bargain barrel, heavy, complicated, politically radioactive, and often sold at discounts that make certain buyers willing to tolerate the friction. China has been one of those buyers, along with traders and intermediaries, operating in the gray zones of global commerce. That doesn't mean China depends on Venezuela in a simplistic do-or-die way. China has diversified supply sources for a reason, but it does mean something more subtle and more important for a financial story. Discounted supply becomes embedded in planning. Refiners build schedules around it, traders build strategies around it, margins quietly assume it. And when a discounted stream becomes less predictable, the pain shows up in places that rarely make the news. Crude differentials, refinery yields, freight spreads, insurance clauses, delivery windows. The consequences arrive like a tax, quiet, cumulative, and hard to dodge. This is where the public narrative often goes wrong. People will argue about the morality of sanctions, they'll argue about Maduro's regime, they'll argue about cartels, corruption, legitimacy, elections, and diplomacy. That conversation might matter politically, but markets don't price morality. Markets price continuity and risk. And the modern way to apply pressure isn't always a blunt blockade or a warship on camera. It's something cleaner: choke points and compliance, shipping lanes, insurance coverage, port access, documentation. A few warnings and a few seizures, real or rumored, can be enough to alter behavior at scale. You don't have to stop every tanker. You only have to make tankers afraid of time. Time is money in shipping. A large crude carrier delayed for a day can bleed tens of thousands of dollars in daily operating costs, not even counting opportunity cost, contract penalties, or the knock-on effect on scheduling. Multiply that by uncertainty. Will it be inspected? Will it be held? Will coverage be challenged? And you create a scenario where firms decide the risk-adjusted return isn't worth it. So the ship turns away before anyone touches it. The trader cancels before the penalty clause activates. The insurer raises premiums or tightens language. The port asks for more documentation. The bank asks for extra compliance sign-off. And suddenly, a policy signal turns into a market-wide slowdown. Inside Venezuela, that kind of slowdown is especially punishing because the system is not built for flexibility. When exports stall, storage fills. When storage fills, output can be forced to slow, not because the ground runs dry, but because the logistics choke. That doesn't always happen overnight, and you shouldn't claim it does. But the direction of pressure is real. The exit points matter as much as the wells. And here's the key point for a safe version of this story. It's not that one enforcement step automatically crashes production and triggers a global crisis. It's that the pressure adds to an already fragile stack. Underinvestment, aging infrastructure, sanctions complexity, limited storage, and the constant need to route barrels through a world that is increasingly sensitive to political risk. That's how systems break. Not with a single blow, but with compounding friction. Now shift your attention to Beijing, not as a villain or hero, but as a planning machine. China's energy strategy is not sentimental, it's not ideological, it's industrial. A manufacturing superpower treats energy like oxygen, not because it can't buy oil elsewhere, but because it wants optionality, multiple suppliers, multiple routes, multiple pricing arrangements, multiple hedges. A discounted barrel is valuable not only for its price, but for what it frees up: cash, margins, strategic inventory. When a discounted supplier becomes harder to access, the cost isn't simply the price of replacement crude. The cost is the loss of leverage, the loss of the cheap input assumption, the loss of one more bargaining chip in the global energy chessboard. And it doesn't stop there. Heavy crude has technical realities. Certain refineries are optimized for it. You can't always swap in lighter grades without efficiency losses, blending adjustments, and margin compression. Energy systems aren't plug and play. They're tuned over years. That tuning is what turns a supply disruption into a margin event. So if Venezuelan flows become less reliable, Chinese refiners and traders aren't just thinking, we'll buy from somewhere else. They're asking a harder question. How exposed are we to a system where access can be tightened through enforcement, shipping scrutiny, and financial compliance without a formal escalation? Because that is the modern battlefield. Not a battlefield of explosions, but of paperwork, premiums, and permissions. And once that question enters your planning, your response doesn't have to be loud. It just has to be logical. This is where many dramatic narratives leap too far and claim a currency war has begun. That's too neat, too cinematic, too absolute. But here's the more realistic version, and it's still powerful. When a country believes its physical supply chains can be pressured, it looks for ways to reduce vulnerability. Some of those ways are physical: stockpiles, pipeline projects, alternative routes, long-term contracts, refinery upgrades. And some are financial, because the real amplifier of American enforcement power is not just naval reach. It's the financial architecture surrounding global trade, dollar settlement, global banking compliance, insurance networks, and the enormous incentives that keep most of the world operating inside that ecosystem. If you can't change the sea overnight, you try to change the incentives that govern the sea. That's where currency and capital markets enter the story, not as a Hollywood declaration of war, but as a longer, slower repositioning. Here's how that repositioning tends to look in reality: not a sudden announcement, not an emergency revaluation, not a single dramatic move. Instead, it's small shifts that accumulate. More trade contracts settled in alternative currencies where possible. More bilateral arrangements that reduce friction with sanctioned or politically sensitive partners. Gradual expansion of non-dollar payment rails and clearing channels. Encouraging foreign participation in domestic bond markets, carefully with controls. Building credibility around assets and institutions that can absorb global capital in a crisis. None of this kills the dollar. But it can erode exclusivity at the margin, and in markets, margins matter more than slogans. Now turn the lens back to Washington. The United States has extraordinary advantages: deep capital markets, the world's most widely held reserve currency, and a security footprint that shapes global logistics. But those advantages come with a cost structure. Global presence is expensive. Enforcement is expensive. Policing risk across oceans is expensive. And in the modern era, those costs interact with the bond market in a way many people underestimate. Higher spending can widen deficits. Wider deficits can mean more issuance. More issuance can mean higher yields, unless demand expands fast enough. Higher yields increase debt servicing costs, which feed back into deficits. That feedback loop matters because it turns geopolitical decisions into financial variables. If investors begin to see a pattern, enforcement expansion here, deployment costs there, deficits widening, yields rising, they don't have to panic to react. They only have to adjust their assumptions. And that's how long-term shifts begin, not with collapse, but with subtle repricing. This is why stories like Venezuela sparks global currency war are often misleading. The stronger story, the safer, more accurate story, is this. Geopolitical enforcement can increase friction in physical supply chains. That friction can raise volatility and risk premiums. That volatility can influence inflation expectations and rates. And rates over time reshape capital flows and currency dynamics. That chain is not guaranteed. It's not instant, but it is plausible, and markets live on plausibility. Meanwhile, in the middle layer of this story, something else tends to emerge whenever pressure rises, the shadow layer. Ships change flags, ownership routes through shell entities, registries shift, transponders go dark, cargo manifests get creative, transfers happen ship to ship. This isn't new, and it doesn't prove a grand conspiracy. It's simply what happens when there's money to be made and enforcement creates pricing distortions. Where compliance increases, arbitrage is born. And that shadow layer introduces its own risk. Misidentification, accidents, diplomatic incidents, and sudden disruptions that can hit third parties. That's one reason these situations can feel more unstable than they technically are. The system gets noisier, the fog thickens, the risk premium rises, not necessarily because supply disappears, but because certainty does. And uncertainty is its own commodity. If you want to understand why a policy signal near a sanctioned producer can ripple outward, don't look only at barrels. Look at the premium markets attached to risk. Look at freight rates. Look at insurance language. Look at the cost of time. Because this is how economic warfare actually operates in a mature global system, not with constant force, but with incentives and fear. Now, does this automatically mean China responds by pushing its currency higher or launching a financial counterstrike? No. That's the kind of claim that turns analysis into propaganda. China manages its currency for domestic reasons first: growth stability, employment, export competitiveness, financial system control. Any appreciation or tightening signal reflects a complex mix: capital controls, rate differentials, domestic credit conditions, and the global dollar cycle. But here's what can be said responsibly. If a major economy feels increasingly exposed to enforcement-driven friction, it has more motivation to strengthen its financial resilience. That can include encouraging deeper domestic capital markets, attracting stable inflows, diversifying reserves, and expanding the use of its currency and trade where feasible. And those steps, taken over time, can create real pressure on the assumptions that have anchored the dollar's privilege, not because the dollar is about to die, but because the world is becoming more motivated to build alternatives, even if those alternatives remain partial. This is the heart of the strategic shift your original text was trying to capture, and it's important to keep it grounded. The conflict isn't only about who controls oceans, it's also about who sets the rules and incentives of global exchange. That contest doesn't announce itself. It creeps. It shows up as small changes, a larger share of trade settled outside the dollar in specific corridors, a broader willingness to hold non-dollar assets at the margin, a slow recalibration inside institutional portfolios that were once built on a single assumption that the dollar system is not just dominant, but neutral. And neutrality is the first illusion to die when enforcement becomes a tool of policy. Now let's talk about the investment consequences, because this is where the YouTube story becomes a financial story. When geopolitics raises the probability of supply friction, markets price in premiums. Energy volatility can feed inflation narratives. Inflation narratives influence rate expectations. Rate expectations move bonds, bonds move currencies, currencies move capital flows, and capital flows in turn influence everything: equities, commodities, emerging market stability, sovereign borrowing costs, and even political behavior. Because when financing tightens, governments get less room to maneuver. This is why you can start with a story about a sanctioned oil producer and end up with a conversation about reserve diversification and currency preference, not because there is a secret plan written on a napkin in a back room, but because the global system is interconnected through prices, and prices are interconnected through confidence. Confidence is the true battleground. A navy can control a strait, but nobody can fully control confidence. Confidence can shift quietly. A pension fund reduces exposure by a few percentage points. A central bank increases reserve diversification slightly. A sovereign wealth fund adds hedges it didn't need before. A multinational renegotiates settlement terms. Each move is small, none makes headlines, but together they change the slope. This is why the most dangerous narratives are the ones that claim sudden collapse. They cause people to look for fireworks and miss the steady drift. The steady drift is the real story. So here's what the safe conclusion sounds like. Still cinematic, still compelling, but rooted in reality. What's happening isn't proof that the world has entered a dramatic new era overnight. It's evidence that the lines between energy, logistics, finance, and power are becoming harder to separate. Enforcement in one domain creates incentives in another. Pressure on physical flows can accelerate financial adaptation. And adaptation, once it begins, tends to keep going, because every episode becomes a reminder. Venezuela is not the center of gravity here. It's a mirror. It reflects how pressure is applied in the modern system. And the modern system is built on a trade-off. The United States can project immense control over physical movement, but maintaining that control is costly and politically complex. China cannot instantly secure every route, but it can steadily build financial options that reduce exposure over time. That's not a prediction of imminent victory or defeat for anyone. It's the shape of a longer contest. A contest decided less by a single crisis and more by accumulation. Risk premiums that become permanent, compliance burdens that reshape trade routes, portfolio shifts that alter funding costs, and currency usage that slowly diversifies. In that environment, the biggest mistake is treating these episodes as isolated. They're connected by incentives. Each time pressure is applied through choke points, it teaches the world the same lesson. Access can be conditional. And once that lesson is learned deeply enough, the response isn't necessarily retaliation, it's redesign. Redesign of supply chains, redesign of settlement rails, redesign of reserves, redesign of the assumptions inside every model that once treated the dollar system as the default. That's why you should watch what happens next, not only on the water, but on the balance sheet, because the next phase of this story, if it continues, won't be defined by the loudest headlines. It will be defined by the quiet decisions made by insurers, traders, refiners, central banks, and institutional investors who care about one thing above all: not ideology, not drama, predictability. And when predictability becomes scarce, the entire world reprices.